Hey everyone, welcome back to my channel. Today I'll talk about an essential aspect of trading, which is identifying supply and demand zones. These zones are important as they can indicate high probability trading opportunities. I believe that identifying supply and demand zones is a skill that every trader must have, since these zones represent key areas where repricing or buying and selling pressure has been dominant. By pinpointing these zones, you can anticipate potential price reversals, breakouts, or areas of high liquidity. Obviously, there are various techniques to identify supply and demand zones. Some traders rely on technical indicators, while others prefer to analyze trading patterns or past market data. Personally, I have found that when supply and demand components like the impulse move combines with a downside break of the assets base structure, it suggests the formation of a supply zone as sell orders surpass the demand orders. I think that these moves are particularly evident when analyzing this 5-minute chart, since they do define, in my view, this entire supply zone. And by the way, to successfully identify such a zone, it's important to learn how to draw them the right way on a chart. This involves obviously observing the current market price, looking back at previous price levels, but most importantly, identifying strong impulsive moves or large candles that indicate intense selling activity. It should be noted that the same concept can be applied to a demand zone where the market makes, again, a fast impulsive move out of the asset's first base structure, where buyers tend to overpower sellers, leading to potential price increases. All right, so as we take another look at the 5-minute chart, we can see that once we hit the 46.24 level and reverse, there is a clear shift in market bias, followed by a price breaking straight through the bottom of a small range that precedes this impulsive 10-point dumping move. Technically speaking, when the price of the asset drops suddenly and rapidly below its base structure, the market, if you noticed, continued to move downwards without hesitation due to an imbalance between buyers and sellers. This impulsive movement, which is a well-known smart money manipulation tactic, confirms to me that structurally the previously identified mini range is indeed a supply zone. And now, if we can use this technical observation as a guide for the market, we can create a strategy. And what that means is that when the market, after basing for a while down here, retraces back to the zone, and let me scale down to a 1-minute time frame real quick. So when the market retraces to the supply zone, and by the way, guys, here it's important to note that the market has to retrace so that it can temporarily restore price equilibrium to a level where supply and demand forces are in balance. So when the market corrects itself by retracing back to the supply zone, we can then establish a point of interest. Now, when it comes to analyzing the market, my preferred approach, as I'm sure you have noticed, is to use price action and identify key market structures. I do believe that combining these two elements with other confirming technical factors can create a winning formula for entering trades with a high probability of success. In this particular scenario, when the price printed inside the supply zone, which again confirms our point of interest, the downside momentum increased due to the prevailing trend. What's more, the breach of support at the 46.10 level after the break in market structure further accelerated the trend. So all of this information leads us to this potential short entry point with obviously a stop loss above this level. My point here is that by incorporating price action and understanding market structure, we can gain solid insights into optimal entry and exit points. This approach, I think, allows us to measure, obviously to a certain extent, the strength of trends and capitalize on high probability trades more effectively. Again here, the main point of this tutorial, guys, is for you to understand that when trying in an uptrend to identify a demand zone, if there is no impulse move breaking through the top of the asset's base, which marks the first leg of a trending structure, then the area becomes just another sideways or consolidation pattern, but certainly not a demand zone. Conversely, in a downtrend, prices are pushed suddenly and rapidly lower from the asset's base structure through an impulse move, which is formed by heavy selling pressure on the supply side as sellers significantly exceed buyers. And another thing here, guys, although in this video I have shared with you some solid tips on supply and demand strategies, obtaining more information in terms of making this strategy more effective is essential. And this video right here contains, I think, additional insights into the supply and demand dynamics. Therefore, I highly recommend you watch it next if you really want to improve the probabilities of your entries. All right, guys, thanks for watching. See you in the next one.